All right, hello, and welcome back to the Broken Business Models podcast. We are your hosts, Ryan and James. And before we get started, just a quick disclaimer: nothing in this podcast or any of our other materials should be taken as investment advice. James and I could have positions in any of the stocks we may mention today, and we reserve the right to change those positions at any time. So always make sure you do your own work and consult with a professional before making any investment decision. With that being said, the topic of today's podcast is going to be Opendoor. So for those of you who might not have been thinking about Opendoor recently, Opendoor is one of the companies that came out of the SPAC mania back in 2020, and their business model is essentially house flipping on a massive corporate scale. So Opendoor is what's called an iBuyer or instant buyer of single family homes, and what they do is they have this online platform where homeowners can go onto this platform and sell their onto this website and sell their homes to Opendoor almost entirely online, which makes it much quicker. Doesn't use any real estate agents throughout the process, and basically allows people to sell their homes to Opendoor very quickly. Opendoor then takes these homes, performs any necessary repairs, maintenance, etc., and then tries to flip those homes as quick as possible for a quick profit. The business model in general is to sell the homes for a higher price than they buy it for by cutting out as much of the cost in the process as possible, and also often making lowball offers to homeowners to buy the houses at as low a price as possible. This might sound like a good idea in general, but Opendoor has not been able to make a viable business model out of it, despite the fact that it's online and a technology company supposedly. It is not more efficient than the traditional method of real estate transactions with real estate agents and showings, etc. One of the big reasons for that is that the business model necessitates an extra transaction in the process. So instead of just a homeowner selling a house directly to a buyer, they sell it to Opendoor, who then holds it for a period of time before selling it to the next home buyer. Also, during that interim period, Opendoor must hold the home, which incurs non-trivial expenses such as maintenance. They have to mow the lawn, and etc. while they're trying to sell the house, insurance, property taxes during that time, and also the cost of capital, because they usually borrow money to buy these houses, and so they have to pay interest on that capital during the time when they're holding the house. So in this chart on the bottom right here, I have the financials for the first half of 2025. As you can see, the first bar is their revenue, and their gross profit is only a very, very small proportion of their revenue. So their margins are very, very thin. And the difference between their revenue and gross profit is essentially the difference in the buying and selling price of the homes. If you then subtract the cost of holding the homes for the period of time between when they buy and when they sell, you then get the contribution profit, which is even lower than the gross profit, and subtracting off their corporate overhead and sales and marketing and things like that, you get their net profit, which has pretty much always been negative. And this is also despite the fact that they've been making these massive net losses, despite the fact that in the early 2020s they actually benefited from holding the houses through the kind of 2021 era when house prices were increasing massively. Despite that, they were still generating losses. So basically, it's an unviable business model that is not as efficient as they had claimed. Looking at their financials over the past few years, as I mentioned just now, they've incurred massive losses over the course of the entire time they've been public. So you can see in 2020, 21, and 2022, they were scaling up the business massively. That was back when the housing market was booming and interest rates were low, etc. And so they were doing a lot of this house flipping, but they were always making large losses, losing hundreds of millions of dollars each year. Since then, they've had to scale back the business, and they've focused more on trying to improve their margins and going into branching out into a few other business models like listing and other services for real estate agents, etc. Yet, despite that, they're still making large losses. Recently, however, Opendoor's stock price has surged massively. Basically, it's become a meme stock, catalyzed in large part by Eric Jackson, this guy on the bottom right, who has been tweeting out a lot of these kind of AI generated memes about Opendoor. And so Opendoor's stock has surged as a meme stock, um, despite no real improvement or major change in the company's prospects or financials. So that's basically the background of Opendoor. With that, I'll hand it off to you, James, to talk a little bit more about what's going on recently with this meme rally.
Yeah, so as Ryan explained earlier, Opendoor has incurred operating and net losses since inception. But now we have this recent meme rally. Investors are excited about the stock. So let's dig a little deeper and analyze in more detail the very recent performance of Opendoor to see if that can in any way justify the kind of tenfold increase we've seen in the stock price over the past couple months. So over the past 2 quarters, Opendoor's revenue has indeed increased and their losses have improved. They're still losing money as of the most recent quarter. They had a negative net profit, but at least revenue appears to have been going in the right direction. However, as I'll explain shortly, this is basically a mirage because the improvement in financials over the past 2 quarters is completely unsustainable, and the company will go back to declining very quickly. The reason this is so, as Ryan explained earlier, the way Opendoor makes money is that you have they purchase the house from a buyer and then they try to flip it at a higher price. Now, obviously, the lower the price that Opendoor can purchase the house, the greater the gross profit they will make. So, if they give lowball offers, they will get a better gross profit margin. Of course, there's a flip side to that. If you give lowball offers, then the buyers are less likely to accept those offers, um, and then you're not going to be able to buy as many homes. So, if say your house is worth approximately $300,000, if Opendoor would offer $280,000, that's only a slight discount. Maybe a lot of people would be willing to accept that deal, but then the margin would be extremely low for Opendoor because they have so many other costs and they'd probably lose money. So what Opendoor decided recently to do is, because they have always been losing money and they need to finally try to find a way to turn to profitability, starting in the previous quarter, kind of starting in Q2 2025, they said, okay, this is how we're going to get to profitability. We're only going to make extremely low ball offers. So if we ever are able to purchase a home, we can make a large profit on that individual home. Of course, the problem is that very few people are willing to accept their lowball offers. So we can see here, this chart shows their inventory in terms of the number of homes that Opendoor owns. And previously they owned about 6,000 homes, and then that increased to 7,000 by the end of the first quarter. Then they started making the lowball offers, and their number of homes in inventory has declined massively, and they only had 4,500 homes. Now, if you have less homes in inventory, well, that means you have less homes that you are able to sell, and your revenue will decline in the future because you just don't have as many homes to sell. So, Opendoor gave guidance that in the third quarter of 2025, they expect their revenue to be to decline 47% quarter over quarter. So they say, because they're giving these lowball offers and their inventory has declined so much, their revenue is going to fall by half, and they're going to make a greater profit on each home. But because their revenue and sales are going to decline so much, that's not going to be enough to cover their corporate overhead, and they're guiding to have a negative operating profit. So they're guiding to have an operating loss in the third quarter and to have negative adjusted EBITDA in the third quarter. So that's sort of the catch 22 that Opendoor is in. If they try to scale up the business, the only way that they can scale up the business and increase revenue is to give higher offers, in which case they'll probably lose money on each home once you consider all the holding costs and property tax, etc. If they want to make favorable unit economics. The only way they can do that is to give extremely low ball offers. But if they do that, their revenue will decline so much that it's not going to be able to cover their corporate overhead. So, and the revenue is going to decline by 50% as they just guided to in the third quarter. So, this kind of just proves that the business model cannot work. No matter what they do, there's a trade off, right, between giving high offers versus low ball offers. And no matter which option they choose, they're still going to lose money. So the business has been a complete failure. Now, the news since this rally started, so catalyzed by Eric Jackson and all his memes that he posts on Twitter, that got a lot of retail investors interested in the stock, and the stock price has surged tenfold over the past couple of months. Now, there has not been any favorable news. The actual performance of Opendoor itself is declining, as we just showed. They expect revenue to decline 50% in Q3. There's only one piece of news that Opendoor has announced that could perhaps be viewed as favorable. So on September 10th, they announced that they fired their existing CEO, and then they're hiring this new guy called Najedian to be the new CEO. And then they also said that Opendoor's founder, Eric Wu, who used to be CEO but stepped down a few years ago, and he also stepped down from the board of directors, he's going to be rejoining the board of directors. So there's basically a change in CEO, and the founder is coming back. And then so this was viewed by a lot of the retail investors as a great positive thing. So why do they think this is a positive thing? So this Kaz Najedian guy, he used to be the chief financial officer of Shopify. And then they say Shopify, supposedly is a company that is very knowledgeable about AI, artificial intelligence. And then this Kaz Najadian guy um, is going to bring that expertise to Opendoor and allow Opendoor to integrate AI into its business, and that's going to improve things. However, Opendoor, basically since the company was founded, and definitely since they went public in 2020, Opendoor has always bragged about, oh, we have such great AI. That's how we're able to value these houses very accurate because our AI is so good. That's what they've always said. And yet they've always lost money. Now they're just saying the same thing. Oh, now we're hiring an AI guy who was the chief financial officer of Shopify. And this guy knows so much about AI that he's going to be able to turn the business around. But Opendoor has already been claiming to have great AI for its entire lifetime, and the business has still failed. So why should we believe that just because they hired some new guy who used to work at Shopify that's somehow gonna change things? It's complete BS. And then the point of Eric Wu rejoining the company. Now, he's not rejoining the company; he's just rejoining the board of directors. So Eric Wu, he was the founder of Opendoor. Back when they went public in 2020, he was a board member and the CEO. And then shortly after the company went public, Eric Wu stepped down as CEO, and he stepped down from the board of directors, but he stayed at the company as the like president of product or something. So Eric Wu has always been at the company in some form for the entire period of time. He has never really left the company. He stepped down as CEO, but he took a different position as like president of product or something. And now he's rejoining the board of directors. Makes absolutely no difference to like how the company is going to operate because Eric Wu has already been there the whole time. So it makes no difference at all. And the reason we're kind of analyzing this change in CEO and Eric Wu rejoining the board, I mean, it's really not that important. It's not going to solve any of Opendoor's problems, but we have to analyze this because that's basically all there is to analyze. If we're trying to explain why the stock price has increased so much, well, we have to look at if there has been any good news. The financials have been a disaster. Revenues, they've guided for revenue to decline almost 50% in Q3. And so the only thing that you could possibly construe as positive is this change in CEO. And they're now trying to jump on this AI narrative, despite the fact that they've been talking about AI since the company was founded. And so the conclusion we can draw is that this massive increase in share price, there's almost 20-fold increase in share price since Eric Jackson started pumping the company and posting all these AI generated memes on Twitter. There's no substance to it. The company has been failing since it went public. They have always lost money. They will continue to lose money. the financial performance is getting worse, not better. And this is frankly one of the dumbest meme rallies that like we've ever seen in the stock market. So that about wraps it up for everything we had to talk about Open Door today. As always, if you have any opinions or thoughts about the company, please let us know in the comment section below, and we will see you all on next week's video.